Let's look at what's up and down with housing. I'm Todd Ballinger, and for 24 years, I've studied the financial services industry from both sides of the balance sheet, assets, liabilities, and what we like to call the third side, real estate. And look at the impact that some of the current dynamics could have on your financial net worth. Some of the key takeaways right now: the U.S. economy continues to slow, as do some of the corporate earnings. Jobs have continued to improve. That's a positive for housing. Savings, however, has dropping down to 3.7 last month, and that's a negative for new housing formations. Inventory is still dropping, and that's a positive for housing. Valuation still declining. That's a negative for housing. So what we have here is a bottom is forming, but it's still weak. We've got some positives and negatives on the housing industry. Some markets are better than others. All real estate is local. And one of the key drivers we're finding right now is population growth. If you're in an area that's growing, that's really supporting overall house prices. Washington's still working to stimulate housing and the economy. Again, right now, the overall picture is we have a positive base, but this is going to take some time. So when we look at where are we now, if I look at it from a point of maximum financial risk to a point of maximum financial opportunity, we've seen that in the investing world, we're still in a place of a lot of anxiety with the European, the Greece crisis, now Spain. And then over here on housing, we really haven't moved that much. We're still somewhere between hope and relief. Now, part of that has to do, and if you want to hit the pause button, you can spend a little more time on this housing summary, and looking at some of the numbers. But up here in the top right, there are a couple of key things to look at. 22% of Americans own a home free and clear. That means they own their home, they have no mortgage. 34% of Americans have a home and they have equity in their home. They have positive net worth. The other 44% of Americans, almost half, either are renting today or they own a home, but they have negative equity. So when we look at new home sales and recessions, we have an adjustment down to 328,000 new home sales, revised down from 353. We're still staying in that 350, sort of 360 range overall. We're seeing a bottom form there, but we need to see that continue to move up as it is now. A record low 48,000 completed homes, new homes, were available for sale in March in the U.S. So we've continued to see this number moving down, and we see here we're at all-time historical lows for completed, under construction, or raw land that's not started yet, that's been permitted. So we're continuing to see that have a positive impact on housing prices in the new housing area. The new home months of supply has creeped under the 6-month level to 5.3 months. That's very positive. When the inventory is below 6 months, that's a positive for housing prices. When it's above 6 months, meaning it's taking longer to sell, people tend to start discounting their houses. So we want to see that stay under 6 months. That'll be a very positive overall for house pricing in general. One of the bright spots is on Trulia, its new price monitor, which looks at the overall prices of home. And they're seeing that new home asking prices are actually going up over the last 2 to 3 months, over 1.4% higher in March. That means that new home buyers, new home sellers are able to get a better price than they originally thought for their home. So that's a positive sign that we're seeing in some markets prices starting to tick up. Home inventory, again, is unchanged. When we look at existing home inventory, it's still at around 6.3 months. So new home inventory is below 6 months. Existing home inventory is right about 6.3 months. But it has dropped again for the 13th straight month, and that's very positive. Overall, house prices, though, have continued down. So this is an important thing to understand, is that even though we're seeing our bottom form in housing and inventory, prices have continued to trail down over time. Now, what's good is the overall price index, including distressed and non-distressed housing, are both turning up now. And this is very positive. That means that overall, the house pricing power is starting to move from this negative number up to the zero line. Once we cross there, we start to see some positive house price appreciation once again. Part of this is driven by the fact that distressed property sales as a percentage of total sales continues to drop on a month-over-month basis. One other very positive thing that we mentioned was that we're seeing Robert Shiller's work and looking at population growth, and Dr. Dave Altig showing that this population line, as long as it continues to grow, will also help to put a floor under home prices. So building costs have been very stable, and house prices have come down dramatically. As population continues to grow and interest rates stay low, those will be a very, very positive dynamic force for property prices to start going up again in the future. Overall unemployment claims are critical. Remember, when you have job losses and they're staying at a high point, people can't make their payments, you see more foreclosures, more distressed properties, and that hurts pricing overall. We've continued to see the unemployment claims drop down to this 357 number. And we're also seeing, while the foreclosures are being worked out through the legal system, you'll notice that the number of delinquent borrowers is going down. And you'll also notice that the foreclosure starts, these are new foreclosures that are being started, are also continuing to trend down, as well as foreclosure sales. Again, very positive overall for the real estate recovery. This has forced the consumer sentiment up into a positive area here, a very high reading in our current range of 75.7%. So this lets us know that the typical consumer is starting to see some of this in their local neighborhoods. You've seen a number of charts showing lower rates, but many people don't know the 15-year fixed hit an all-time low of 3.13%. And there's a possibility now we could see a 3% 15-year fixed. The 30-year fixed has had an average of 3.98%. So it has maintained its average below the 4% level again for 2 months in a row. This is helping with overall homeowner financial obligations. We can see the mortgages, the larger of these compared to consumer debt, but this is trending down because more and more consumers are taking advantage of these lower rates, and we're currently at a 14% level. The average American is only carrying 14% of their gross income is being carried as mortgage or consumer debt. We need to start replacing that lost home equity. The average home equity has dropped from over $200,000 at the peak to $78,000 today. So more and more we're looking at homeowners starting to try to recover those savings through either direct savings or through accelerating the payoff of their mortgage. Now, overall personal savings, though, while that spiked in 2008, 2009, again after the crisis, because there's been some higher expenses and some inflation, we've seen personal savings has started to decline, and we're back now below the 4% rate at a 3.7 overall personal savings rate. That affects future home formations as consumers need to save money now to be able to buy and start their family, starter homes at an early age. When they buy those starter homes, that allows people that are in the starter homes to buy larger homes, and that trickles all the way up and down the system. One of the problems we've seen is even though unemployment has come down, average income, personal income, disposable income, and average hourly earnings have all gone down, meaning that many of the new jobs have been lower paying jobs, and that will obviously not help housing longer term. When we look at the problems in housing, there are different ways to address it, capitalization or reducing rate. We can see that the two areas that are gaining a lot of favor are principal reduction and principal deferral. Reduction means we just wipe out some of your principal. Deferral means we just move it down the road. 30 years from now, you can pay that principal back for the time being. We're going to defer maybe 10, 20, or 30% of your mortgage. So those are becoming favored by banks as ways to help people through the modification process. Overall, when we look at some recent studies on moving, the inability to move has affected how long people have and live in a house. While it had been as low as 5.7 years and then as high as 7, we're seeing that now we're in an 8 to 9 to 10 year range, an average being about 9 if you take the volume based on all four markets. So the average consumer is living in the home for about 9 years. It's still a good time to buy. We've talked about not only the low interest rates, but we can see that the median house price is back down here to close to 160. We can see that the family income, when we look at now being a good time to buy, we can see that the overall median house price has in fact continued to trend down. The income and median family income is stabilized and is going back up again. And we can see that the mortgage payment as a percentage of U.S. income has really continued to drop and making it easier for people to afford those houses. The overall principal and interest payment, if you actually look at this line here and go across, we're back to the same cost today to buy a house as it cost us back in 1995 based on the price and current interest rates. So one of the things that we're seeing is people that have cash are taking advantage of these lower property values. Over 31% of all sales last recorded period in February were cash sales. Only 2/3 were using some type of financing. We can see that the median house prices have increased from 143 to 219 and now dropped back to about 166. So many people are taking advantage of these lower house prices and moving back into the overall market. So again, key takeaways. Overall, we have a positive base building. It's just going to take some time. What we need to see is positive jobs, positive savings, positive inventory, the shadow inventory not coming in and squashing the prices, and overall valuation beginning to pick up. That'll be the four-part recipe for a sustainable rally in real estate.